Cathie Wood is the #1 hotshot fund manager right now, managing over $50 billion of investor money. Although last year was a great year for the Ark Funds, 2021 so far has been a little bit turbulent. Let's take the Ark flagship fund for example. So the year started excellent and the fund shot up over 25%. We then had a big sell-off and the funds came crashing down almost 30%. And now, so far this year, the funds are still down over 1%. So the question is now the time to be selling and taking profits, or is now just a good buying opportunity? Well, that is what we're going to be answering in this video. Cathie Wood does have a very unique and strong vision for the company, and this is built around what she calls the 5 major innovation platforms. So this is their impact of innovation going all the way back to the 1780s. And you can see we had the invention of the steam engine, followed by railways, followed by the internal combustion engine. Then in the 1900s, we had huge innovation of the telephone, automobile, and electricity. Then nothing for about 80 years before computers came, followed by the internet, and now we have these 5 huge innovation platforms all happening at once. Blockchain technology, genome sequencing, robotics, artificial intelligence, and energy storage. But the Ark funds have struggled so far this year, and even Elon Musk has reached out to Cathie with concerns that the stock market is looking a little bit overvalued. So in this video, I do have some clips from Cathie Wood, and also we'll be covering 4 main things. First up, what exactly did Elon Musk say to Cathie, and what was her response? There's an update to the Buffett indicator, which is flashing some dangerous red signals. We'll then look at Cathie Wood's bold prediction for bonds, and then finish by answering the question, is now the time to buy or sell? As always, if you do find anything useful in the video, be sure to drop a like, and that's always very much appreciated. Okay, so first up, Elon Musk reached out to Cathie Wood last week as he had some concerns about the stock market. And here is what he said. What do you think of the unusually high ratio of the S&P market cap to GDP? So, with those that are not familiar with the ratio of stock market to GDP, it's known as the Buffett indicator, as Warren Buffett had said that it's probably the best measure that we have to know whether the stock market is overvalued or undervalued. And basically, if you take up the value of all the companies in the stock market, you then divide it by GDP, which is gross domestic product, it then gives you a percentage. And this is what Elon Musk was questioning. Let's take a look. So this is the Buffett indicator that he was referring to, and this goes back to 1950, and as mentioned, it gives us a percentage. Now, historically, it's been going between this 50% and 100% range. And the times that it's broken past 100% is when we've had a big stock market crash. It broke it again in 2008. We had another stock market crash. And this is the unusually high ratio he was referring to. It's now broke past over 200%. Now, before we get into the response by Cathie Wood, I too can offer a simple explanation as to why it might be so high. So think about it, a large part of GDP is all the products and services that are being sold. And as we are in the midst of a global pandemic, people are not spending money as they normally would be. Now, of course, this is going to lower GDP, and by default, it's going to increase this ratio. And I think when we get back to normal, this indicator will begin to come back down. Now, this is not to say that the indicator won't still be really high, because I think it will. But for me, this does answer the question as why it is so high. Anyway, that's my 2 cents worth. Let's now listen to what Cathie Wood had to say, and her response was very interesting. Check it out.
Elon Musk responded to us and asked the question about, I guess it's the Warren Buffett indicator. I didn't know it was called that. But it is a ratio, the equity market cap in the U.S. To GDP. which is as high as it's been really with the exception of the tech and telecom bubble. But if you go back about 100 years, this is about as high as it gets. And so we've done a lot of research on not just the past 100 years, but prior to that as well, because the past 100 years, and especially post World War II, where we have the best statistics, they've been good guides. The highs and lows, the bases, and so forth. But we're in a new era, and it's much more like the late 1800s and the early 1900s. And if you look at that same ratio back there, it's much higher, much higher. And I think one of the reasons for this is the denominator. GDP is made up of both real growth and inflation. And if we're right, and these 5 major platforms, 14 technologies, are all deflationary in nature, and they're going to become a bigger part of the economy. Think electric vehicles going from 2.2 million sales globally last year to 40 million in 5 years. And we think the growth in the US is going to be as fast as that 82% compounded at an annual rate. If that's right, and these major deflationary forces begin to move the GDP needle, it means the denominator is moving down. All other things equal, to say deflation pulls the denominator down relative to the numerator. And that means the ratio is going up. So I think you do have to go back to the last time we saw major innovation platforms evolve at the same time. There were only 3 back then: telephone, electricity, and automobile. There are 5 now: DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology. And they are going to deliver profound changes in the global economy. Anyway, the deflationary forces of 5 innovation platforms are going to be powerful. And then add on top of that the deflationary forces associated with companies that have not done the right thing over the last 20 years. Those two are going to be tugging at GDP, and I think pushing that ratio higher.
So she does make a very interesting point. Now, everyone looking at the Buffett indicator are only checking it for, say, the last 50 years. But Cathie Wood and the team went all the way back to the late 1800s, early 1900s, and they found that the indicator was even higher than it is today. And she mentioned with these 5 big innovation platforms evolving: blockchain, genomics, robotics, AI, energy storage. And if she is right, then the Buffett indicator will be going even higher. Now, you have to give her credit for her analysis. No one else has this line of thinking. Okay, so moving on. She now has some really interesting points about the bond market. And as there is more money in bonds than any other asset class, excluding Forex, even if you don't invest in bonds right now, they are still important. And here's why. And it's because the bond market is a massive market. We are working in the trillions of dollars, and this is the size of some of the global markets. We have bonds, stocks, gold, crypto, and silver. And if you think the stock market was big, look at the size of the global bond market. And if there's problems in the bond market, you could start seeing huge capital flows into other asset classes. And this is why it's important to follow what's happening with bonds. And here we have the 10-year Treasury yield. So this is how much money you would make if you would lend your money to the government for 10 years. And you can see, going back all the way to 1880, historically, you could get a risk-free return of close to 3 to 5%. Now, bonds went through an awesome period where you could get over 10%, even over 15% risk-free return. But for the last 20 years, the bond yield has been falling, and it's now around 1.67%. The question is, will bonds make a comeback?
And when you think about it, if we're right on this deflation call, the long-term Treasury yield probably is not going to go much above 2.5 or 3%, if we're right. And that suggests that the valuation of the market.
Cathie Wood does not think the long-term yield is going to rise much past 2.5%. So this is basically saying that getting a great risk-free return from bonds is now over, at least in the short term. And if inflation picks up, we could then see a large amount of money begin flowing out of bonds and into other asset classes. So very interesting stuff. Okay, and to finish up, with all the volatility going on in the markets, especially with the Ark ETFs, is this the time to be selling and taking profits? Or is this a great buying opportunity? Is Cathie Wood herself panicking? Let's find out.
And so, as I mentioned last time around, for those of you who have been concerned about the volatility in the markets, the volatility in our strategies, all that did from our point of view is give us bargain prices so that we started once again to concentrate towards our highest conviction names and got some great opportunities as the rotation into value was taking place. It was taking place out of names like ours. And we will use those opportunities every time because our price targets are not going to change. These long-term price targets are based on well-defined cost curve declines and the price elasticity of demand estimates. If we get a change on either one of those, then of course we'll adjust. But a volatile market is not going to change anything in our 5-year targets. So we're very excited about the equity market. And also innovation. We love the fact that we're engaging on Twitter with Elon Musk and lots of other executives and investors and innovators and individuals. And we love getting those sorts of questions. We need to stay on our toes. That's what we intend to do. And so with that, I wish you a very happy spring weekend.
So for Cathie Wood and the team, all this volatility did was create some bargain prices on their largest holdings. So this was more of an opportunity to buy in at lower prices than it was anything to worry about. They work off a 5-year plan and fundamentally nothing had actually changed. In fact, she has said that they are very excited about the equity market right now. So, in summary, bringing all this together, Cathie Wood doesn't see the Buffett indicator as a major concern right now. In fact, they went back all the way to the early 1900s and apparently it was much higher than it is today. She doesn't see bonds making a major comeback, which means there could be some major outflows and into other asset classes. And the volatility of Q1 didn't actually change anything for her and the team. In fact, they saw it as a great buying opportunity. So there you are guys, hope you found this useful. In fact, just one favor to ask, if you did find anything useful in the video, if you wouldn't mind taking 2 seconds just to drop a like, and a big thank you to everyone who does, you guys are awesome. If you haven't yet subscribed to the channel, I invite you to click below and join us. I do have some great videos coming up that you don't want to miss. Okay, cheers guys, thanks for watching, and I'll see you in the next video. Bye for now.